You know, when you see the daily economic headlines, there's always a deeper story behind the numbers. A story about how money is really flowing in and out of the United States. Today we're going to unpack one of those stories, a giant IOU that has some twists you probably won't see coming. All right, let's get into it.
We're going to start right here with this number, negative $450.2 billion. Now, according to the Bureau of Economic Analysis, that was the U.S. current account deficit for just the first quarter of 2025. I mean, it's a staggering amount of money, and it's our starting point for understanding a much, much bigger picture.
So, what in the world is the current account? Well, the simplest way to think about it is like a financial scorecard for the entire country against the rest of the world. It tracks everything from the cars we import and the software we export all the way to investment income and even foreign aid. It really is the broadest measure we have of all our international money flows.
Now, for most people, when they hear about a big deficit like this, their brain immediately jumps to one thing, the trade deficit. You know, the idea that we buy way more physical stuff from other countries than we sell to them. And look, that is a huge part of the story. But it's not the whole story.
Check this out. Here's how that big deficit breaks down. That huge negative bar on the left, that's the goods deficit, the one that gets all the media attention. Right next to it, you see our surplus in services, which is something you always hear as a big strength of ours. But I want you to look at those two little bars on the right, primary and secondary income. They look kind of insignificant, right? Almost like a rounding error. But hidden inside one of them is an absolutely jaw-dropping secret.
So let's do it. Let's dig into that secondary income category. This is a part of the economy that rarely, if ever, makes the news, but it reveals something truly eye-opening about where America's money is actually going. Okay, so secondary income is basically a one-way transaction. It's money that gets transferred without getting anything in return. No goods, no services. It's not a payment, it's a transfer. The two biggest examples of this are personal remittances, that's money people earn here and then send to a family back in other countries, and government transfers like foreign aid.
And here's the first big surprise. That services surplus we just saw, the one that's always pointed to as a sign of our economic strength, well, get this, it gets almost entirely canceled out by the deficit in secondary income. For pretty much all the money we're making from selling services, a nearly equal amount is just flowing right back out the door.
And this brings us to the absolute core of this explainer. Because when you stop looking at these numbers just one quarter at a time, and you start adding them up over the long run, a figure emerges from the data that is, frankly, shocking.
Since 1999, the data shows the amount of personal remittances coming into the U.S. is a tiny $150 million. But the amount going out, it's not millions, it's not even billions. It is $1.1 trillion.
$1.1 trillion. Just let that number sink in for a minute. This isn't government spending, this isn't corporate investment, this is money earned in the American economy that is then sent overseas as personal gifts.
Think about what that really means. Since 1999, over $1 trillion in value created right here in the United States has just been transferred abroad, one wire transfer at a time.
To try and wrap your head around a number that big, let's put it in perspective. The total value of Tesla, you know, one of the most valuable companies on the planet, is around $683 billion. The amount of money sent out of the country in these remittances is massively larger than the entire market cap of Tesla.
Or think about it this way, $1.1 trillion is enough money to build 81 of the most advanced nuclear-powered aircraft carriers in the world. So this is not some small leak in the system, it's a massive, sustained outflow of capital.
So, okay, why does this matter? How does some abstract number like $1 trillion actually affect your daily life? Well, it all comes down to a simple but powerful chain reaction in our financial system.
See, there's a fundamental rule in economics. The books always have to balance. So if you have a current account deficit, all that money flowing out for goods and these transfers, you must have a capital account surplus to balance it out. And what that means is that foreign money has to flow back into the U.S. to buy up American assets like stocks, bonds, and especially real estate.
So here's how that chain reaction plays out. Our huge deficit forces us to have a huge surplus of foreign capital to make the math work. That means there's a constant, massive river of foreign money chasing U.S. assets. And what happens when a lot of money is chasing a limited number of assets? The prices go up.
And that constant upward pressure on asset prices is a key but almost completely overlooked factor in our housing affordability crisis. That giant IOU we started with isn't just some abstract number. It directly contributes to the price you have to pay for a home.
Knowing about this hidden trillion-dollar outflow completely changes the conversation about America's economic challenges and what's really driving the prices of our most important assets.
When you look at what's driving these one-way outflows, it's not even close. Personal remittances are the overwhelming piece of the puzzle, totally dwarfing the money that gets sent out as government transfers.
So, while the goods deficit gets all the attention, this massive trillion-dollar outflow of personal wealth is this quiet, structural feature of our economy. It's a huge piece of the puzzle with some major consequences, and it's a story that is almost never told.
Which leaves us with one last question. When you really consider its sheer scale and its direct link to the affordability of something as fundamental as housing, could this be the most important economic story that almost nobody is talking about?